Hello, good afternoon, and welcome to today's episode of Modesty's Mortgage Masterclass, where we come every Wednesday to educate ourselves and learn a lot about the mortgage and the property markets at large. So it's our midweek tonic, and this is session number 25 for Modesty's Mortgage Masterclass. And I hope your week has been going on well. Well, mine has been good because this week I decided to take advantage of the Eat Out to Help Out scheme. I mean, we're helping out the hospitality industry in the community. So it's been a good experience, and I must laud the initiative by the government on the help Out to Help Out scheme. It really has given the hospitality industry a boost, and because they were one of the hardest hits in this COVID-19 pandemic. But hey, we've been encouraged to go and eat out, and the government takes care of part of the bill. And then why not? I realized that I thought I could just walk into any of the restaurants that was taking part in that scheme and just sit down and have some. I realized that a lot of the good restaurants have been booked out, even up until next week Monday, and I was like, what? I was late to the party, but I managed to find somewhere nice to eat out at least as well to help out. So thank you very much, Rishi Sunak. I really appreciate that kind gesture. Okay, so today on this show, we're going to be talking about something that is really very important in the world of mortgage. The way we work these days differ a lot, and a lot of people are now working on contracting basis, so they are working as contractors, and these people also have mortgage needs. So the rise of contractor mortgages is very significant, and lenders are beginning to adjust their lending criteria, realizing and appreciating the fact that the way people work are now different. So contractor mortgages is one of the things we're going to discuss today, and we're also going to be talking about eviction bans. There's been news on eviction bans, and we're going to look at what the latest is around eviction bans, and we're also going to look at some other updates around the mortgage and property markets. So we've got a bumper package on our hands today, and I hope you enjoy that. So let's just get straight into the nitty-gritty of what we're going to be talking about today. But hey, before I do that, let me still formally introduce myself. For those of you who still don't know me, I remain your man, Ikenna Umezudike. I'm the director of Modesty Financial Consultants Limited. We are a financial consulting business based in Luton, United Kingdom, specializing in mortgages, in financial advisory services, and investment advisory and financial consulting. And hey, I've got news again for you. The Modesty Group is gradually growing, and very soon we are now our estate agency business is going to be having a full launch very soon. A lot of underground and background works are going on, and very soon you soon see our presence everywhere on social media and all other places. But already we've started listing properties in the name of Modesty Property Consultants Limited. So if you go on Zoopla right now, we've got property we've listed in the name of Modesty Property Consultants on Zoopla. This is something that I have really been dreaming of achieving, and it's one of the milestones that I've achieved. So please spare a prayer for, because this is not going to be easy, and I'm in the business to make a difference. That's why I'm in it, because there is something I really want to add to the estate agency industry. I have been working as an estate agent on behalf of some other big firms in conjunction or in partnership with them, but something happened and I really needed to give myself that extra push, and we have done it. We've taken the bravery we've beaten the bullet to say, hey, let's go it on our own. So Modesty Property Consultants Limited is born. Other things are being taken care of in the background, and when we fully launch, you will know, and you will soon see us being very present and very active in the estate agency market, especially in Luton and its environs. And so it is in a bit, we just want to use that platform to affect lives as well, because there's going to be a very, very major focus on social responsibility around what we do. And that part of social responsibility, you will know as well, and we're going to really need your help and support to help us drive that goal through. So watch this space, okay? Now let's talk about the mortgage updates. What's exactly has been happening in the mortgage world? Average rates still continues to rise in the mortgage industry. Since July, the average interest rates have been creeping up, and that upward trajectory still continues. And I've said it here a couple of times in the last couple of weeks about how lenders are increasing interest rates and increasing their rates. So on average, rates on mortgages have been increasing. And I have said many times that we live in a crazy world where things are happening upside down. At a time when we thought, the base rate is at its historical low, and everybody expected mortgage rates to be at its historical low, from March up until July, it was like everybody was having a good time as far as rates are concerned. And then since July, it started creeping up. And people have been asking why that is the case. I've explained that in some other sessions we did, that look, lenders are stretched when it comes to human resources and staff compared to the amount of mortgage demands and requests that they are getting. Again, an indication of the crazy world we live in. When people expected mortgage demands to be dropping, mortgage demands are increasing to the point that lenders are unable to cope now. And what they are doing is they are raising rates so that they can manage the workflow and manage their resources efficiently, because they haven't got the staff strength to deal with that increase in demand in mortgages. So they are using rates to control they are using rates to control demand, because they feel that the higher they put up the rates, the more discouraged people are to go for mortgages, at least to just reduce the workflow. But then the demand is still coming in there, but because even with the increase, it is still very much at an affordable range for a lot of people who are looking for mortgages. It's still a very low interest rate regime we're operating, even with the rate, but that's a tool they're using to manage workflow. And also what we have noticed that more products as well are also being withdrawn from the market as well by the lenders, and some of the products that are withdrawing from the market are products that were priced low before, and once they increase the rates, they will replace them with the new products with a higher interest rate, or new products with some other attributes and criteria added to it. So products are being withdrawn from the market. Excuse me, some of them are being replaced, some are not being replaced. So it means the availability of products in the market is also shrinking. So we're having lesser and lesser products available in the market, especially in the high loan to value range of products. So it's a challenging time for people who are looking to borrow, in the 90-95% loan to value range. For 95% loan to value is almost history now, because there's barely any lender that offers 95% loan to value, just a handful if there is any. And 90% loan to value also very, very rare to find lenders in that market. There are lenders in that market, but they are not that much. So those high loan to value mortgages are really the availability on those are really very low in the market. The other key thing is that lenders are becoming more and more cautious in terms of lending. So the appetite to lend among lenders is not that very high. The reason being that they are not very confident about the economy, especially the job markets. So the uncertainty surrounding the UK economy what's going to happen after this furlough scheme ends in October. And even before the furlough scheme ends, we have been hearing of dramatic job losses in several big companies. British Airways alone shed 12,500 jobs. Other companies like Debenhams and all that, they are all cutting jobs. So there have been in total over 750,000 job losses already in the UK. And the UK is officially in recession. So these gloomy pictures and these gloomy situations, give the lenders a serious cause for concern, because they are not very sure what's going to happen in the future. So what the lenders are doing now is that they are tightening their criteria for lending, making sure that every penny they lend is watertight and secured against a formidable, provable income that is sustainable, and that mortgage has the potential of being repaid, because they are being very cautious. So their criteria is becoming tighter and tighter. So the confidence among lenders for the economy is not really high and not really strong. They're really concerned about what the economy is going to look like, especially after the furlough scheme have come to an end, and with the recession and the uncertainty in the economy and job losses and all that. They really want to be sure that they are lending responsibly and lending to people who can afford the mortgage. The other thing I mentioned in the last session we did as well is that lenders are bracing themselves for a high number of mortgage defaults, because all these people that are losing their jobs, these people have got mortgages to pay. So if they haven't got any income coming, the obvious thing is that they're going to default on their mortgages, and it means there will be a lot of mortgage defaults. So lenders are actually really setting aside some more money for to plan for COVID and to plan for those expected mortgage defaults. And all these things are adding to the pressure on the side of the lenders, and then they're increasing rates on their mortgages. At least if they're going to be lending, they want to make sure it's worth the risk that they are taking. So, and because of reduced capacity due to shortage of staff, and a lot of people are still working from home, so lenders are still saying, look, we can't take in all these demands. We have to manage our workflow efficiently, and the people we have in the office are never enough, because the office have to be rearranged, and with COVID and all that, people have to be well spaced out in offices, and not everybody comes in at the same time. And we are also noticing as mortgage brokers that our SLA, our service level agreement with lenders, the time frame is becoming longer. It's taking longer to process and assess mortgage applications than it usually takes. So we're appealing to our clients when we apply for the mortgage to say, please exercise patience. The situation we find ourselves in is nobody's fault. It's of nobody's making. So we just have to exercise patience and also understanding in this whole case. So the reduced capacity is affecting the speed of processing and assessing mortgage applications and making decisions. So which means mortgages are taking a little bit longer than they used to complete and to do the things that needs to be done. So these are the things that are happening around mortgages and rates and availability and products and lenders, their confidence and all that. But then the other thing we just want to highlight here is, listen, with the average rates increasing and all that, if you find yourself in a situation where your fixed rate has come to an end, and you're looking to revert to this standard variable rate, you might want to think twice. Take advantage of the low rates, even though the rates are increasing, but they are still low enough. Take advantage of the low rates and fix those mortgages if you want certainty and stability in terms of your budget. So if you want to be sure of what you're paying every month, it makes sense for you to take advantage of the low rate we find ourselves and fix your mortgage if that is your priority. Fixed rate mortgages are not suitable for everybody. right? But for those who want certainty over how much, certainty and stability over their mortgage payments, and then for their budgeting as well, to know, okay, in the next 2, 3, 4, 5 years, this is how much I'm going to be paying for my mortgage, and I want to be sure that that budget is built and that budget is steady, so that they don't, continue to expose themselves to the rigors and the ups and downs of standard variable rates and rates going up and coming down. So if you don't want to find yourself in that situation, and usually if you do that, you could save yourself up to an average of £150 a month, by fixing that mortgage and getting out of the standard variable rate, if you want to take advantage of that. But if you want a simple enough mortgage that just says, okay, this is my mortgage, whenever it comes, I pay what the mortgage is. I don't want the complexities of being tied into anything, because once you fix it, you are tied into that. If you don't want to be tied into anything, then standard variable rates might be what you'll be looking at. Okay, so but that's just something to think about. Okay, I am not offering you any advice, because I'm not allowed to offer you any financial advice here. I'm just offering you information. It is your decision to now make. And before you make that decision, please speak to a mortgage advisor. If you come to me in the capacity as a mortgage advisor, I am more than happy to offer you advice where we have an agreement that advice will be offered to you. Okay, so that's it about mortgage updates. The other thing we want to discuss now is the eviction ban. Hi, Christian. Good afternoon. Welcome, bro. Eviction ban. When this pandemic broke out and the lockdown was brought in March, the government said landlords cannot forcefully evict anybody from their properties. Landlords, whether it's public or private landlords, you cannot evict any tenant, for a minimum of 3 months. And then after 3 months, it was extended for another 3 months. So it was meant to end on the 23rd of August. That eviction ban was meant to end on the 23rd of August, which was last Sunday. But then the government, close to that deadline, now extended that ban again for another 4 weeks, meaning that landlords cannot evict tenants again until September the 20th, until 20th of September 2020. So there's a 4-week extension now of the eviction ban. So landlords cannot enforce eviction on tenants until that deadline occurs. So, and in the new rule that the government have brought in, they will need to give tenants at least 3 months notice, even after the ban, right? They will need to give tenants at least 3 months notice in England. In Wales, it's 6 months notice now. So until March next year, in Wales, if after the ban is lifted, landlords cannot evict tenants until they give them 6 months. So they have to give them 6 months notice to vacate the property, or you cannot enforce the eviction ban. So you have to give them 6 months notice. But now in England, it's 3 months notice. But before the pandemic, it used to be 2 months notice. Once you serve a tenant 2 months notice and they don't get out of the property, you can, start the process of repossession of your property. So, but COVID has turned everything upside down. So it's now 3 months notice before you can even start the eviction process after the ban, that is. So, but if a repossession order has been served on you as a tenant before the 27th of March, it means that after the ban, the landlord can actually enforce that eviction notice just within 14 days. So if you've had eviction notice served on you before the 27th of March this year, you are an exception. Your case is an exception as a tenant. It means that if after the ban is lifted on 20th of September, the landlord can enforce that eviction just within 14 days. Okay? But if you have not been served any eviction notice before the 27th of March, if your landlord wants to evict you from the property, they have to give you 3 months notice first of all, and that has to be after the ban, before they start the process of eviction and repossession. So, according to the housing secretary, he said the ban, is after the ban is lifted, there will be some cases that will be given priority in terms of enforcing the eviction. Cases that involves serious cases of antisocial behaviors in the property, or cases of crime, and then unpaid rents that are over 1 year. Those cases will be heard first by the judges. So if you're a landlord, you can imagine, how this sounds. Some landlords have arrears dating as far back as 1 year, meaning that for 1 year, the tenant has been living in your property and they've not been paying rent. And then COVID happened, and some of the tenants are now hiding behind COVID as an excuse to say, hey, you can't kick me out. I haven't got money. I can't pay the rent. The government is protecting us. So this particular announcement has, generated a lot of reactions. So some of the reactions now are actually mixed, depending on whose interests you are protecting and whose interests you are representing. Now, for example, the homelessness charity called Shelter, they've said that about 230,000 private tenants, have fallen into arrears since the pandemic. 230,000 private tenants, that's tenants living in private landlord properties, have fallen into arrears since the pandemic started, and over 170,000 of them have been threatened with eviction. So what the picture they are painting here is, if this ban is not in place, our street might be flooded with homeless people. There will be a lot of people thrown out there, and they are living out there on the streets, being homeless. So you can imagine that this charity, because they are representing the interest of the homeless people, they are welcoming the ban. I mean, they are welcoming the ban on eviction, the extension on the ban. They said it's a welcome development because it has helped prevent massive homelessness being executed in England and Wales. And they are saying that that's a very good decision by the governments, and therefore, because they are representing the interest of the homeless, they are saying it's good. Okay, so but what they want the government to do is, within these 4 weeks that they have extended this ban, to use this time wisely to, iron out their strategies and the structure they need to put in place for a more permanent solution, because you cannot continue keeping landlords out of their right, away from their rights to exercise eviction, because you're not paying these landlords anything. So you've got to find a way of supporting those who are at the risk of being made homeless because they are going to be evicted from their property because they have been in arrears. So health bodies as well are also warning that, look, if homelessness becomes rampant, there is a risk that coronavirus could actually be on the increase, because it means that there will be more crowded places in properties in England. People will be forced to live, in crowded spaces, which is really against the message of preventing the spread of the virus. Again, if people are out there on the streets, homeless, they are more likely to spread the virus, out there. So the health bodies are also saying that there is also an angle of a health risk to this. And then even the Labour leader, Keir Starmer, is also welcoming the extension on the eviction ban. But he's just saying that, look, this is just a plaster on the wound, that this is not a permanent solution. The government should come up with a more permanent solution. Okay, so these are reactions from people who are basically not active participants in the property market. Now, what are the landlords themselves saying about these announcements? Well, your guess is as good as mine. So the landlords basically have been left frustrated and angry at this announcement by the government. And what they are saying is that they are really, really kicking against this, and they are saying to the government, look, part of our frustration is that there is no way, even after the ban, that we can quickly and swiftly get these people out of our properties to recover and repossess our properties. Because even after the ban is lifted, they still have to serve them another 3 months notice before they can even start processing, before they can even start processing the repossession order and even start enforcing it. So with the announcement also coming very close to the deadline of the initial extension, because this deadline was meant to be 23rd of August, but very close to the deadline, the government now made that announcement and said, hey, listen, we're going to extend this by 4 weeks. So you can imagine the frustration. A landlord looking forward to repossessing their property and kicking tenants out who have refused to pay them rent. And then the government says, hey, you got to hold on for another 4 weeks. And even after that, you still have to give them 3 months notice. So landlords feel that they have been rendered powerless in exercising their legal rights to evict tenants who they feel are not the right fit for their property. Because the truth of the matter is that some of these tenants have been exhibiting antisocial behaviors in the property. Some of them might have committed various crimes in the property. I mean, take for instance, if actually you notice that a tenant has been using your property to grow cannabis, and you're trying to kick them out and to evict them, you may not even have access to the property, because they may not even allow you into the property because the ban is in place. So there are lots of, or they've been doing drugs and all kinds of crime on the property. You can't even enforce that. You can't even enforce the eviction because your hands are tied. And then there are tenants who have just deliberately refused to pay their rent, and they are hiding behind the government protection to deny hard-working landlords the rent that they deserve. So cases of antisocial behaviors and crimes and disruptive, some tenants are so disruptive even to the neighbors and to their housemates that they're just not a perfect fit for the landlord, but they can't kick them out because the government is protecting them. So most landlords feel that these tenants are hiding behind COVID to perpetrate several atrocities and deliberately decide not to pay their rent. And some of them, quite honestly, can afford to pay the rent. They just don't want to pay it. Some of them are receiving benefits from the government that warrants that they can pay the rent, they can afford it, but they're just not paying it because they know you cannot kick them out. So obviously there's an outright condemnation of this blanket extension by the government from the Landlords Association. So private landlords feel that they have been left to bear the burden of the government's failure, that the government have ignored their responsibility towards their citizens, and they are shifting their responsibility and the cost and the burden onto landlords. So what the landlords are calling for is a balance between protecting tenants and also supporting landlords who own these properties. They are actually asking the government to basically offer some financial assistance to landlords beyond just the mere mortgage holiday. And mortgage holiday is not even a financial assistance. Mortgage holiday is just, kicking the can down the road, like postponing the dates of payment of your mortgage. So taking a mortgage holiday basically means that you're going to get a 3 months break, but you still owe those mortgages. So you're going to pay those mortgages, but not just immediately. So it's not financial assistance. Hi, Chukwuemeka, good afternoon. Thanks for coming on. It's not like a financial assistance. It's simply just allowing them to extend the time that they have to pay off their mortgages. So the landlords are asking for more financial help rather than just mere mortgage holidays, which some of them are not even happy to take anyway. So if you are a tenant, my advice would be, please pay your rent if you can. There's no point hiding behind COVID and thinking that you can get away with, rental arrears. The landlord will still exercise their legal rights after the ban. And no matter how long it takes, they will still come back to haunt you, because if they succeed to go through the legal system to, recover their property, they will pursue the recovery of their rents as well. And it might lead to you having a CCJ, a county court judgment registered against you, which will affect you and impact on your credit rating in the future. So if you can't pay your rent, please pay your rent. It's not just about being it's the moral thing to do. It's morally right for you. You can't just live in somebody's property and refuse to pay rent. Somebody worked hard to get that property and put you in there, trusting that you fulfill your side of the bargain. We understand the struggle these days and that people are in financial difficulties, but hey, if you can afford to pay your rent, please do. But if you're struggling to pay your rent, you can speak to your landlord or the estate agent and try to come to some kind of payment arrangements on how you can be reducing the arrears. They will assess your ability and, they will be reasonable about it. I mean, it's all about dialogue and communication. You don't just bury your head in the sand and thinking that the problem will go away. No, you've got to confront the problem before it goes away. So speak to the landlord, speak to the estate agent, and find a way around it and get some kind of payment arrangement agreed and start paying it off. Just chip the block off a little bit. Before you know it, you are done with the arrears. If you're on benefits or if you are receiving universal credit and you are still struggling to pay your rent, you might be able to get discretionary housing payment support from your local council. So why don't you speak to your local council about this discretionary housing payment support and see if you're eligible for that and see if you can get that. That could help you in reducing the arrears and paying your rent. Okay? So landlords, we feel your pain, we feel your frustration, we feel your anger, but the law is what it is, and we just have to wait, and then when the ban is lifted, we'll deal with it. Okay, now let's talk about contractor mortgages. Yeah, so contractor mortgages is basically mortgages for contractors. Now, there are several types of contractors. The way people work these days constantly changing. More and more people are preferring to work as contractors. Some of them on fixed-term contracts with their employers. They are employed, but their employment is on fixed-term contracts. And when those fixed-term contracts run out, the employers can either choose to renew it or terminate it, depending on how the relationship goes or the need for that service. Some are, just contractors. It's not fixed term, but they are just self-employed contractors. So they are not employed contractors, but self-employed contractors. Some are paid through an umbrella company. Some are paid through an agency. So there are so many complicated ways people earn money these days. Okay? More and more people are seeking to take control of their own income. Therefore, they want to become contractors so that they want that flexibility that comes with it, but also it comes at a price. With the flexibility comes the uncertainty, because you don't know what's going to happen by the time that contract ends. If that contract ends and it's not renewed, it means the end of income. So you have to wait for maybe a few months before you get another contract. So because of this complexity around contractors and the way they are paid and the way they earn, some of them are paid directly into their bank accounts, in their individual names. Some are paid directly into their business bank accounts. Some are registered as sole traders, some are registered as limited companies. Some are paid through an umbrella company as well. So you can see that there are variations to these contractors and the structures and the way they are paid and all that. So lenders have studied these various types of contracts and contractors, and they are constantly adjusting their product offerings to match the way people work, so that the more the way people work and earn changes, their products are becoming adaptive to those. So contractor mortgages are becoming more and more popular because these contractors also have housing needs and they also want to access mortgages. So if they don't fall into the category of the normal borrowers who earn monthly salary, there must be a way to accommodate them into the mainstream, into the stream of borrowers. So contractor mortgages have been designed to suit this need. So because of that, contractor mortgages are a little bit different from your normal conventional mortgage of somebody who is working and earning salary, who's got a pay slip, or who is a self-employed, that's got a business they're running, and they produce their accounts and they say 302. So it's different. So because of this difference in the way these people appear and the way they work, lenders have also structured their products to match that. So how, as a contractor, how you are paid affects the way lenders assess you and the way your affordability is assessed. Because one of the key things that is considered in mortgages and application is affordability. So lenders have to be comfortable with the fact that you can afford this mortgage. So they have various criteria that they use to assess affordability. So in the case of mortgage contractors, the way you are paid affects or influences the way lenders assess your affordability. So some lenders will assess your affordability based on your daily rates. If the invoice or the pay slip that you get bears your individual name rather than your business name, or if it's paid in, or whether it's paid into your limited account or whether it's paid into your business account. Now let me break this down. So to some lenders, as long as the invoice or the pay slip is in your individual name, they can assess it based on your daily rates, right? And not treat you just like a normal self-employed individual, which means that they will not be requesting for SA 302, your business bank statement, and your business account for the financial years. So if they are going to be assessing based on your daily rates, the invoice has to be in your personal name. Whether the money is paid into your limited company account or into your individual bank account is inconsequential to them. This is to some lenders, not all lenders, right? So they just want to know in whose name is the invoice or the pay slip issued. If it's issued in the limited company name, they will treat it as a self-employed application. And every criteria that pertains to self-employed applications will be will apply to that particular application. But if the invoice bears your personal name, they will treat you as an individual and thus assess it based on your daily rate. That's for some lenders. And then some lenders will assess you based on your daily rate. And then to determine how much they will take your income to be, they will now take your daily rate multiplied by the number of days that you are working, that the contract specifies that you're working, and then multiplied by the number of weeks. Now, the number of weeks differ from lender to lender. Some lenders use 52 weeks, some use 48 weeks, some use 46 weeks. Okay? So when you do that calculation, it will then tell you what your gross annual earning is going to be. And based on that gross annual earning, they will now assess your affordability. Now, let me give you an example. Say you're a contractor and your daily rate is £250 per day. And this lender wants to assess you based on a 48-week working year. So if they want to find out, if they want to know what the gross annual income should be on which the basis of affordability will be, what they are going to do is they are going to say £250, which is your daily rate, times how many days do you work as specified in that contract. If it's 5 days a week, Monday to Friday, they're going to multiply that by 5. And because they're using a 48-week year, they're going to multiply that by 48. So that gives you £60,000. So it means that for the purpose of affordability assessment, they're going to take it that you're earning £60,000 per year. Okay? Now, if that lender is using a 52-week window to assess your affordability, the outcome will be different. Now, look at that. on the same £250 for 5 working days in a week, it's going to be £250 times 5 days that you're working times 52, and that gives you £65,000. So you can see for two contractors earning the same amount on daily basis, you can see that their gross annual income are different depending on which lender they are talking to, or which lender is assessing their affordability. So if you're talking to a lender who is assessing you based on a 48-week, your gross annual income will be 60,000. If you're talking to a lender who is using a 52-week window, your gross annual income will be £65,000. So which means the one with £65,000 can borrow more than the person whose gross annual income is £60,000. And if you want to use the income multiple to decide how much these two people can borrow. So the difference will now be for the guy who is earning 65,000 based on 52-week window, the income multiple means that he can borrow a maximum of £292,500. While the guy whose gross annual income was £60,000 can then borrow £270,000. So you can see there is a £22,000 difference. That's massive in terms of how much they can borrow, depending on which lender and what criteria they are using. So some lenders will insist that gross annual income must not be less than 50K for them to accept that application and for them to consider it. So if, for example, your contractual earning is, say, £150 a day, so £150 times 5 working days times, say, 48-week window, you're on £36,000. So some lenders will say, no, we cannot entertain this because you're earning far too little. While some lenders don't mind, as long as that amount can carry the what you are looking to borrow. Because if you're looking to borrow, say, £100,000 and you're on £36,000 contractor, so you can borrow maximum of £162,000. So why not? Or if you're looking to borrow £150,000 on £36,000, you can borrow more than £150,000. So why not? So it depends on how much you are looking to borrow as well. But some lenders have a minimum amount that they would accept from contractors before they consider that application. Some lenders would like to see 12 months minimum left on your contract, or 6 months or 3 months. So the most people 12, 6, 3. Some lenders don't mind seeing 3 months left on your contract. But if you have like 3 months left on your contract, they would like to see the track record, the past contract that you've been on. Maybe they want you to have been in that line of job for at least 2 years, meaning you've got experience in that job. So even if this contract runs out, if your contractor is not renewing it, they want to know that there's a prospect of you getting another contract very soon, because you're an experienced person in that line and they expect you to be okay. While some lenders will want to see a guarantee from your employer that they are going to renew that contract before they accept the application. Some lenders will want to see a renewed contract, like you have had a contract before and that contract has been renewed before. So it means that you've been on that same contract for more than a year. If you have that track record, yes. Some of them don't mind how much you've got left, while some will insist, no, it has to be at least 6 or 9 months left on the current contract for us to consider that. Some lenders will require to see a copy of your existing contract documents and your past contract documents to show that you have had the contract before and it's been renewed and you've been on the same job. Now, one key thing is about tax treatment. If your employer is paying your tax, you are likely going to be treated as an employed contractor. So that means the lender may not need to see your SA 302 or your business bank statement, they will not treat you like a self-employed contractor. They will treat you like an employed contractor, right? So they will just decide your case based on your daily rate because your tax is already taken care of. Now, the reason some lenders would rather treat you as self-employed instead of as a contractor, as far as you are not employed, is because you are responsible for your tax payments and your tax liability as a self-employed. And because of that, they would want to see the impact of that tax liability on your income before they decide how much they want to lend to you. So they want to see your SA 302 for the past year. And that SA 302 will state how much you have declared as the actual earning from that contractual job, and then how much tax you've paid. So they want to see the impact of the tax liability on you. So that's why some lenders would rather treat you as self-employed and would want to base their assessment of your affordability on the criteria of self-employed rather than just on your daily pay. So if you are responsible for your own taxes, lenders might want to treat you as self-employed rather than just contractors. But there are some lenders who, even if you are paying your own taxes, they will still treat you as a contractor and base their assessment on your daily pay. Okay, so those are just few tips for contractors and for contractor mortgages. I've got a couple of them on my table, on my desk that I'm dealing with currently. So I just felt, to educate you guys on some of these things, because these are some of the things we come across every day as we interact with lenders. So if you've got anything like that, or your income is a little bit complex or complicated, give me a shout and we can see if there is anything out there in the market that suits and fits your need. On this note, folks, I'm going to call it a day for today's mortgage session. Thank you very much. I hope this has been useful to you, and I hope you found it beneficial. Please, 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 would appreciate your feedback on this. Leave us a comment if you have a question or anything you would like to suggest. Please leave it in the comment section on whatever medium you're watching this. And if you would like to see some other things that we have done, please go to my YouTube channel. Just search Ikenna Ume Izudike on YouTube and subscribe to our YouTube channel. It's free of charge. We don't charge you anything for subscription. Okay, so we're not a satellite TV station. Just go there, subscribe, and please don't forget to turn on the notification button so that you'll be notified whenever we add new contents to the channel, because we keep adding new contents to the channel every time. So on there you can watch all the back catalogs of our previous programs, both the Money Masterclass and the Mortgage Masterclass. That channel is loaded, so just go there and enjoy yourself and learn as much as you want to learn. Thank you very much, and I'm going to see you again on Monday for Modesty's Money Masterclass. And next week, Wednesday, we're going to come back with another exciting edition of Modesty's Mortgage Masterclass. Take care, goodbye, God bless, and stay safe. Bye now.